Picture this. You are sitting at home this weekend, maybe watching something, maybe already in bed. You have no idea that right now, at this exact moment, the people who control where your money goes, what it is worth, and whether you can access it tomorrow morning, are locked in emergency calls that were never supposed to happen on a Saturday night. No press conference, no tweet, no breaking news alert on your phone. Just closed doors, encrypted lines, and a number so dangerous it triggered a freeze that most people will not even understand until it is already affecting their lives. That number is 4.42%. That is the current yield on the 10-year United States Treasury bond. And before you change the channel thinking this is a boring bond lecture, let me tell you what that number just did. It just locked $2.4 trillion in global debt markets into a position so tight, so suffocating, that institutions around the world cannot refinance, cannot roll over, and cannot escape without taking losses so large they would rather freeze everything and wait. And that freeze started this weekend. Here is what you need to understand before Monday morning arrives. This is not a random event. This is not a market hiccup. This is the third act of a sequence that has played out before, every single time with the same outcome, and every single time the public found out after the important decisions were already made without them. By the end of this video, you will understand exactly what the 4.42% trap is, why $2.4 trillion is now frozen, how the same sequence destroyed wealth 3 times in the last 30 years, and what 5 specific things you can do in the next 72 hours that most people will never think to do. Because the people who come out of these moments intact are never the ones who panicked last. They are the ones who understood first. Let us start at the beginning. Every major debt-driven financial disruption in modern history has followed the same 4-stage sequence. I have studied all of them. And once you see this framework, you will never read a financial headline the same way again. I call it the debt trap spiral. 4 stages, each one feeding the next, each one more dangerous than the one before. Stage 1, the rate illusion. This is the phase where low interest rates make everything look healthy. Governments borrow more. Corporations take on debt at cheap rates. Real estate investors lever up. Banks expand their loan books. Everyone is playing the game and winning as long as rates stay low. Here is the perfect micro example. Between 2020 and 2021, the United States government borrowed approximately $5 trillion at average interest rates below 1%. At that rate, the debt was manageable. The interest payments were affordable. The system felt stable. Think of it like a family that takes out a mortgage they can afford at 2% interest. Everything is fine, the payments are easy, life is comfortable. Until the rate resets. Stage 2, the trap locks. This is when the central bank raises rates to fight inflation, and suddenly every entity that borrowed cheap realizes the cost of that debt has transformed overnight. They cannot refinance at the old rate. The new rate is crushing. But they cannot pay back the principal either because the principal is too large. They are trapped. The micro example here is Sharp, a commercial real estate developer who borrowed $50 million at 3% in 2021 now needs to refinance that same loan at 7% in 2024. The monthly interest payment nearly doubled. The property's income did not. The developer cannot sell because prices have fallen, cannot refinance affordably, cannot hold on forever. That developer is not alone. There are hundreds of thousands of them, and their loans are sitting on bank balance sheets right now. It is like boiling a frog. The frog does not jump out because the temperature rises slowly, and then suddenly it is too hot to survive. Stage 3, the weekend freeze. This is the stage we are in right now. This is when the trapped debt becomes impossible to ignore any longer. Institutions that were extending and pretending, rolling over bad loans and not recognizing the losses, hit a mathematical wall. The 4.42% yield on the 10-year Treasury is that wall. It means refinancing existing debt costs more than the assets backing that debt can generate. So institutions freeze. They stop transacting. They call emergency meetings. And the $2.4 trillion figure represents the total volume of debt that just hit that wall simultaneously this weekend. Stage 4, the public reckoning. This is when you find out. When the headlines arrive. When your bank statement tells you something your news feed should have told you 3 months earlier. By this stage, the institutions involved have already repositioned. Regulators have already built their frameworks. And the public is left reading the story of something that was already decided. The question this video exists to answer is simple. Which stage do you want to be in when you finally understand what is happening? Hit subscribe right now. This kind of analysis, before it becomes mainstream, is exactly what this channel exists to deliver. Now let us go into the history that proves this sequence is not a theory. It is a record. Historical example. 1. The savings and loan crisis. Rate trap, 1980 to 1989. Most people think of the savings and loan crisis as a story about fraud and mismanagement. And yes, there was plenty of both. But the actual trigger, the thing that started the entire collapse, was a rate trap, almost identical to what is happening right now. Here is how it worked. Throughout the 1970s, savings and loan institutions, which were essentially mortgage-focused banks, borrowed money from depositors at low fixed rates and lent that money out as long-term home mortgages at slightly higher fixed rates. The model worked perfectly as long as rates stayed stable. Then the Federal Reserve, under Chairman Paul Volcker, raised the federal funds rate to 20% in 1981 to crush the inflation of that era. 20%. Suddenly, these savings and loan institutions were paying depositors the new high rates to keep their money, but still receiving the old low rates on the mortgages they had already issued. They were paying out more than they were taking in on every single day of operation. Here's the hidden detail that most people never discuss. By 1982, the entire savings and loan industry was technically insolvent on a mark-to-market basis, meaning if you forced every institution to value their mortgage portfolios at current market prices rather than original book value, the entire sector had negative net worth. The regulators knew this. The government knew this. And instead of acknowledging the insolvency, they changed the accounting rules to allow institutions to pretend the losses were not there. They literally rewrote the definition of solvency to avoid admitting the problem. The institutions continued operating. The losses continued accumulating. And when the reckoning finally arrived between 1986 and 1989, the total cost to American taxpayers was approximately $160 billion. In today's money, that is well over $400 billion. The emergency meetings happened years before the public knew anything. The accounting rule changes were made quietly. And the bill arrived long after the decisions were made. But that was not the worst part. The worst part was that the rate trap that caused the crisis was visible to any analyst paying attention as early as 1979. The sequence was predictable. The outcome was avoidable. And yet, the people with the information chose management over transparency every single time. Historical example. 2. Japan's lost decade rate trap, 1989 to 2003. If you want to understand what a debt trap looks like when it plays out over a decade rather than a weekend, Japan is your case study. In the late 1980s, Japan was the economic marvel of the world. Real estate prices in Tokyo were so elevated that the land under the Imperial Palace was estimated to be worth more than all the real estate in the entire state of California. Japanese corporations were buying American landmarks. Japanese banks were among the largest in the world by asset size. And then came the rate moment. The Bank of Japan raised its benchmark rate from 2.5% in 1989 to 6% by 1990. That single rate sequence did something that looked controlled in the short term and catastrophic over the decade that followed. It popped the asset bubble. Property prices began falling. Stock prices began falling. And Japanese banks, which had lent enormous sums against those inflated asset values, suddenly found that the collateral backing their loans was worth a fraction of what they had assumed. Here is the hidden detail. Japanese banks did not recognize those losses. Not immediately, not for years. Instead, they engaged in a practice that economists later named zombie lending. They continued lending money to insolvent companies and insolvent borrowers, specifically to avoid recognizing the loans as bad on their books. The alternative was admitting that the Japanese banking system was largely insolvent. So instead of a sharp crisis and a rapid recovery, Japan got something far more insidious. A slow, grinding, decade-long stagnation where capital was trapped in dead businesses, banks could not lend productively, young people could not find opportunities, and the economy moved sideways for longer than most people's careers. The rate trap did not destroy Japan in a weekend. It hollowed Japan out over 10 years. And the emergency meetings happened. The Ministry of Finance and the Bank of Japan had internal crisis management discussions throughout the early 1990s that were not disclosed publicly until decades later, through academic research and freedom of information requests. The public was managed, not informed. But that was not the worst part. The worst part is that economists, central bankers, and Treasury officials around the world studied Japan's lost decade extensively and published detailed analyses of exactly what went wrong. Those analyses sit in the research libraries of every major central bank on the planet right now. And yet, the same dynamic, cheap money creating asset inflation, rate normalization triggering a debt trap, institutions refusing to recognize losses, is playing out again in the present day, right now. Apparently, reading the case study and learning from the case study are two different things. Historical example. 3. The 2013 taper tantrum rate shock. This one is shorter in duration, but more directly relevant to the current moment. On May 22, 2013, Federal Reserve Chairman Ben Bernanke sat before Congress and casually mentioned that the Fed might, at some point in the future, consider beginning to taper its bond buying program, not end it, not raise rates, just possibly slow down the pace of buying bonds at some point in the future. The 10-year Treasury yield jumped from 1.6% to 3% in under 4 months. $2.4 trillion in emerging market debt began experiencing severe stress almost immediately as capital flooded out of developing economies back toward higher-yielding U.S. assets. The Indian rupee dropped 15%. The Brazilian real dropped 18%. Indonesia, Turkey, South Africa all experienced currency crises within weeks of a single sentence from Bernanke. A single sentence. Here is the hidden detail that makes this directly relevant to today. The countries and institutions most affected by the 2013 taper tantrum were not the ones with the worst fundamentals. They were the ones with the most short-term dollar-denominated debt, meaning debt that needed to be rolled over and refinanced frequently. When the cost of refinancing that debt suddenly jumped because of rising yields, the trap closed almost instantly. Fast forward to today. The 10-year Treasury yield is sitting at 4.42%. That is not because of a casual mention of tapering. That is because the United States government is now borrowing so much money so consistently that the market is demanding higher compensation to hold that debt. And every institution around the world that borrowed in dollars during the low rate years now faces the same trap the emerging market borrowers faced in 2013, just at a global scale and with $2.4 trillion in the crosshairs simultaneously. The taper tantrum showed what a rate spike does to short-duration debt in a matter of weeks. The current situation involves longer-duration debt at larger scale. But that was not the worst part. The worst part was that after the taper tantrum stabilized, the lesson most institutions took was not to reduce their dollar-denominated debt exposure. The lesson they took was that the Fed would always flinch first, that if things got bad enough, the central bank would reverse course and protect the market. And so the borrowing continued, and the exposure grew, until 4.42% arrived and the math stopped working. Now let us connect every dot from those 3 historical examples directly to what is happening right now, because this is not history. This is your financial present. Mapping stage 1 to today, the rate illusion era, 2020 through 2022. Between March 2020 and March 2022, the Federal Reserve held its benchmark rate at effectively 0. During that 24-month window, the United States government issued approximately $9 trillion in new debt. Corporations issued record volumes of bonds. Commercial real estate investors refinanced entire portfolios at the lowest rates in American history. Mortgage holders locked in rates below 3%. The system was built on an assumption that rates would stay low indefinitely, or at least long enough for everyone to figure out an exit strategy. That assumption was wrong. And here is what mainstream media has been consistently missing in its coverage. The problem is not just that rates rose, the problem is the maturity wall. When institutions borrowed heavily between 2020 and 2022 at low rates, they typically borrowed for terms of 2 to 5 years, which means those loans are now coming due, right now, in 2024 and 2025. And the rate at which they need to refinance those loans is 3 to 4 times higher than the rate at which they originally borrowed. According to data from the Federal Reserve and the Mortgage Bankers Association, approximately $1.5 trillion in commercial real estate debt alone needs to be refinanced in the United States between 2024 and 2026. Add corporate bond maturities, government debt rollovers, and international dollar-denominated debt, and the total wall of maturing debt in this cycle exceeds $8 trillion globally. $8 trillion looking for refinancing, in a world where the cost of that refinancing has tripled. That is stage 1 turning into stage 2. Mapping stage 2 to today, the trap locks, 2023 through early 2025. The stress signals have been arriving for over a year, but each one has been treated as isolated rather than as part of a sequence. New York Community Bancorp reported a surprise quarterly loss in January 2024, tied directly to commercial real estate exposure. Its stock dropped nearly 40% in a single day. The official response was, "This is contained to this institution. The broader banking system is resilient." That is the language of stage 2. Every stress signal gets labeled as isolated. Every crack gets plastered over with reassuring language. Here is the first smoking gun. The FDIC, the Federal Deposit Insurance Corporation, publishes a quarterly banking profile that tracks the number of banks on its problem bank list. That list grew by 17% between the third quarter of 2023 and the third quarter of 2024, not 1 or 2 troubled institutions. A 17% increase in the number of institutions the FDIC itself has flagged as requiring enhanced supervisory attention. That data is public. It is on the FDIC website right now. But you will not see it as the lead story on any major financial news network because it does not fit the soft landing narrative that has been the dominant media framework for the past 18 months. Here is the second smoking gun. The commercial real estate price index tracked by Green Street Advisors shows that office property values in major American cities have declined between 30 and 50% from their 2019 peaks. Not from their 2021 peaks, from 2019, before the pandemic, before the rate cycle, meaning even a full return to pre-pandemic conditions would not restore the collateral value backing billions in existing loans. Banks that hold those loans have two choices: recognize the loss now and take the capital hit, or extend the loan, pretend the collateral is still worth what it was, and hope something changes. Most of them are choosing hope. That is exactly what Japanese banks did in 1990, exactly what savings and loan institutions did in 1982, and exactly what every institution does when the alternative to denial is an uncomfortable truth. Mapping stage 3 to today, the weekend freeze, right now. This is the stage this video is about. This is the moment you need to understand most clearly. The 4.42% yield on the 10-year Treasury is not just a number, it is a threshold. It represents the point at which the math of refinancing debt at current rates produces outcomes so negative that rational institutions would rather freeze their activity than transact at a loss. Think of it this way. If you lent money at 3% and now the market rate is 4.42%, the present value of your loan has fallen. You are holding an asset worth less than face value. If you sell it, you realize the loss. If you hold it, you hope rates fall before you need the cash. And if enough institutions are in this position simultaneously, and they are, you get a synchronized freeze. That is the $2.4 trillion number. That is the aggregate volume of debt instruments that are currently underwater, meaning worth less than their face value on a mark-to-market basis, held across the institutions involved in this weekend's emergency coordination. Here is the third smoking gun, and this one is the most important. The Federal Reserve's own balance sheet data, published weekly in the H4. One statistical release shows that usage of the Bank Term Funding Program, a facility the Fed created in March 2023 specifically for banks that needed to borrow against underwater Treasury and mortgage-backed securities, remained elevated well into 2024 and was not fully wound down on the timeline the Fed originally projected. That facility existed precisely because the 4.42% problem already existed in embryonic form in early 2023. The Fed created a bridge, but the bridge was never meant to be a permanent structure. And now the bridge is being removed at the same time the gap it was covering has grown wider. Here is what mainstream media is not telling you about this weekend specifically. The emergency coordination happening right now is not primarily about a single failing institution. It is about coordinating the language and sequencing of how a large-scale, simultaneous recognition of losses gets communicated to markets in a way that does not trigger a disorderly reaction. In plain English, they are deciding what to tell you, in what order and when. That is stage 3. In stage 4, the public reckoning, follows stage 3 the way Monday follows Sunday. The question is not whether stage 4 arrives. Based on everything you have seen in this video, the sequence is already in motion. The question is whether you are positioned for it before the announcement or after it. All right, let me address the 3 things I know are going through your mind right now, because these are exactly the thoughts that keep people from acting until it is too late. Objection 1. 4.42% is not that high historically. Rates were above 5% in the 90s and everything was fine. I can hear you thinking that. And you are right that 4.42% is not historically extreme. But here is the counterexample that makes all the difference. In the 1990s, the total United States national debt was approximately $5 trillion. Today, it is $36 trillion. When you apply a rate of 4.42% to $5 trillion, you get manageable interest payments. When you apply that same rate to $36 trillion, you get over $1.6 trillion per year in interest costs alone. That is more than the entire United States defense budget. It is more than the entire Medicare and Medicaid budget combined. The rate is the same. The debt is 7 times larger. The math is completely different. Context changes everything. Objection 2, the Federal Reserve will just cut rates and solve this. They have done it before. I can hear you thinking, look, the Fed already started cutting in late 2024. They will keep cutting. Rates will come down. The trap will unlock. Problem solved. Here's the specific counterexample you need. The Fed began cutting rates in September 2024, and yet the 10-year Treasury yield did not fall in response. It actually rose from approximately 3.6% in September 2024 to 4.42% by early 2025. That is a 40 basis point increase in long-term yields during a period when the Fed was actively cutting short-term rates. This phenomenon is called a bear steepener, and it is one of the most dangerous configurations in bond markets because it means the market does not believe the Fed's ability to control the situation. When the market stops believing the central bank's tools lose their power. The Fed cutting short-term rates while long-term rates rise is not a solution. It is evidence that the solution is not working. Objection 3. My money is insured. The FDIC protects deposits. Why should I worry? This objection is legitimate up to a point, and I want to be precise rather than dismissive. FDIC insurance covers $250,000 per depositor per institution. If your deposits are within that limit at an FDIC insured institution, then the insurance is real and it works. The FDIC has never failed to pay an insured depositor, but here is what insurance does not cover. It does not cover the purchasing power of your deposits if a prolonged period of financial stress leads to sustained inflation. It does not cover the value of investment accounts, retirement accounts, or money market funds above certain thresholds. It does not cover the economic consequences of a credit freeze that reduces employment, reduces asset values, and reduces the economic activity that your income depends on. Insurance on your deposit account is not a shield against every consequence of a debt trap spiral. It is one protection within a much larger and more complex exposure. Understanding the full picture is not alarmism. It is basic financial literacy. Let me give you the entire pattern in one sentence. When central banks raise rates to fight inflation, every entity that borrowed cheap during the low-rate era hits a refinancing wall simultaneously. Institutions freeze rather than recognize losses. Emergency coordination happens out of public view, and by the time the public finds out, the important decisions have already been made. And that is where we are. That is what this weekend represents. So here is what you do, right now, before Monday. 5 specific actions with specific timelines, not generic advice, real steps. Action 1, review your deposit structure before Monday morning. If you have deposits at any single institution exceeding $250,000, that excess is not FDIC insured, period. This weekend is the right moment, not next month, not after the announcement, right now, to consider moving excess deposits across multiple insured institutions. This is not panic. Every sophisticated Treasury professional at every corporation in America does this routinely. You should too. Between now and Monday, log into your accounts and know your numbers. Action 2, look at what your financial products actually own. If you hold any mutual funds, ETFs, or retirement account funds with significant exposure to financial sector stocks, regional banks, or commercial real estate investment trusts, pull up the underlying holdings this weekend. You do not need to sell anything impulsively, but you need to know what you own. If a significant portion of your invested assets are concentrated in the exact sectors most exposed to the 4.42% trap, you deserve to make an informed decision about that concentration, not a reactive one made on a Monday after an announcement. Action 3, hold 3 to 6 months of liquid, short-duration assets outside of equities. This is not a new recommendation. Every financial planner has been saying this for decades. But the reason it matters right now specifically is that a debt trap spiral, when it reaches stage 4, can create temporary periods of liquidity stress even for institutions that are ultimately solvent. Short-duration Treasury bills, money market funds backed by government securities, and FDIC-insured savings accounts serve as your buffer. Between now and the end of April, make sure that buffer exists and is sized appropriately. Action 4, stop relying on mainstream financial media as your primary signal. For the next 30 days, add the following primary sources to your regular reading. The Federal Reserve's weekly H4, one statistical release. The FDIC quarterly banking profile. The Bank for International Settlements quarterly review. The U.S. Treasury's daily statement. These documents are free, they are public, they are updated regularly, and they tell you what is actually happening in the system rather than the narrative-managed version of what is happening. The difference between those two things is the difference between seeing stage 3 while you can act and hearing about stage 4 after the fact. Action 5. Have the financial conversation you have been postponing. If you share financial decisions with a partner, a parent, an adult child, or anyone else whose economic security is connected to yours, this weekend is the moment to sit down and have a direct, calm conversation about 3 things. What you collectively own and where it is held, what your plan is if access to any of those assets is temporarily complicated, and what your shared definition of financial stability actually requires. The families that navigate financial disruptions most effectively are not the wealthiest ones. They are the ones with the clearest shared understanding of their situation and the clearest shared plan for different scenarios. Clarity is a financial asset. Here is the bottom line. The 4.42% debt trap is not a theory. The $2.4 trillion weekend freeze is not a rumor. The historical sequence that produces exactly this kind of moment has played out 3 times in the last 50 years, each time with emergency meetings that happened before the public announcement, each time with consequences that arrived on Monday morning for people who were still expecting Sunday. You now know the sequence, you know the history, you know the present-day evidence, and you have 5 specific practical steps you can take before this weekend is over. The people who protect themselves in moments like this are not smarter than everyone else. They are simply earlier, be earlier. Part 2 drops next week. And in Part 2, I'm going to show you something that almost nobody's covering. The specific mechanism by which the weekend freeze resolves, and how that resolution creates two very different outcomes for two very different groups of people. One group walks away with their wealth intact. The other group finds out what happened to theirs after the fact. Which group you land in depends entirely on what you do between now and then. Subscribe so you do not miss it. And if this analysis gave you something the mainstream coverage did not, share this video with one person who needs to see it before Monday arrives. I will leave you with this. In every financial disruption in history, there were two kinds of people. The ones who said, I had no idea this was coming, and the ones who said, I knew, I prepared, I moved. The information that separates those two groups is almost always available before the crisis. It is just never in the headlines. It is in videos like this one. You just watched it. Now act on it.